Welcome to our second BDO IFRS Corporate Reporting webinar for 2026. Thank you for joining us today. We are continuing our 2026 BDO IFRS Corporate Reporting journey through IFRS 18, Presentation and Disclosure in Financial Statements. However, as always, before we dive into IFRS 18, let's cover off some housekeeping matters. For those of you new to the BDO IFRS Corporate Reporting webinar, my name is Dean Ardern. I'm one of the partners in the IFRS Corporate Reporting team at BDO. I'm located in the Melbourne office. I work with a range of for-profit and not-for-profit entities on a broad range of accounting and financial reporting matters. I often jokingly say, and this is for indiscretions, maybe not sins, but indiscretions, I must have committed in a former life. I've been working in technical accounting within government entities and in chartered accounting firms for around at least over 20 years. But the fact is, as odd as it might sound, I actually really enjoy technical accounting, and that has been overwhelmingly helped by the fact that I've had some great pleasure working with some really smart and skilled people, including Aletta Boshoff and Kevin Frobus, who sometimes join me for these presentations, but not with us today. As always, I want to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects at BDO to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islanders peoples joining us today. I'm presenting this webinar from Melbourne, or Naarm, the traditional lands of the Wurundjeri Woiwurrung and the Bunurong peoples who are part of the Kulin Nation. This picture on this slide is of actually Torquay Beach, which is in Brunswick Heads in northern New South Wales, and the traditional lands of the Bundjalung of the Byron Bay Arakwal people. The Brunswick Heads has special meaning to me. It's a really nice place. I spent a lot of time there with my kids when they were little, and that Torquay Beach is just a fantastic beach. I couldn't help but put that slide up. As I mentioned in the January webinar, apart from our traditional 30th of June and 31st of December financial sustainability reporting updates, we have dedicated the remainder of the webinars this year to IFRS 18. So if you haven't already signed up for all of the webinars this year, good time to lock in the dates and times in your calendar. With regard to sustainability reporting, we also have a full program this year. I think I mentioned before in January webinar, notwithstanding Group 1 entities with 31st of December annual reporting dates would currently be up to their literal necks in sustainability reporting as I speak. Group 2 entities, they've got to first prepare their first sustainability reports for financial years beginning on or after the 1st of July 2026. So if you're a Group 2 entity, now is actually a really ideal time to join our sustainability webinar series. Now, this month, apparently, Letta's going to make the case for why sustainability should matter to CEOs and boards, and I'm sure that's going to be a pretty compelling argument. I mentioned, I think, in the previous webinar that BDO Global was actually updating its IFRS 18 in practice publication on IFRS 18. So, as anticipated, the updated IFRS in practice on IFRS 18 is actually now available. The updated version has benefited from a lot of input from the BDO network, and they're thinking about how IFRS 18 might impact their entities and other different entities. The publications of this updated version doesn't impact the materials I discussed in the last month's webinar. So it's the same materials effectively, but you should be aware that maybe some of the references in the materials that I distributed for the last webinar in January, some of those references might have changed to the current BDO updated publication. So just be aware of that. I flagged it during the January webinar, but we are planning to run a series of 3 IFRS 18 virtual masterclasses in the first half of this year. Now, we've tried to time the virtual masterclasses so they avoid public holidays, busy seasons, everything that we could possibly identify. We've also scheduled them for Friday morning. So if you're planning a long weekend, I'm going to have to cut into some of your Friday, but I'm only cutting into a bit of it, not all of it. Each of the 3 masterclasses will cover one of the 3 areas identified by the ISB as being a key change to the IS1 requirements. So the first masterclass, Transitioning Your Profit or Loss to IFRS 18, we'll hold it on Friday, the 27th of March from 9 to 1 p.m. The second masterclass, Transitioning Your Balance Sheet and Cash Flow Statement to IFRS 18, will be held on Friday, the 29th of May from 9 a.m. to 1 p.m. And the third masterclass, Transitioning Your Management Defined Performance Measures, will be held on Friday, the 21st of May from 9 a.m. to 1 p.m. Now, I'm conscious that some of the potential attendees might be interested in 1 or 2 of the masterclasses, whereas some might be keen to attend all 3. So we've incorporated a volume discount into the pricing structure. One thing to note, each of the masterclasses stands on its own. So if you just wanted to attend say masterclass number 2 or 3, not attending maybe the first masterclass, that won't disadvantage you particularly. As noted in this slide, we'll be working through some real examples of entities transitioning to IFRS 18 and looking to how they applied IFRS 18 in their reporting outcomes. Registration details will be circulated soon, so as the webinar is being run virtually, there's not really a limit on the number of attendees. So subject to feedback on this round, also with the masterclasses, we might in fact look to run another set later in the year, but we'll see how that goes. Now, topics today. I've compiled them and prepared them to provide you with really just an introduction to specified main business activities and their implications for entities applying IFRS 18. Now, considering we covered a lot of ground in January, and a lot of what we covered then is actually background to today's webinar, I might actually just start with a IFRS 18 recap of the general requirements applicable to the preparation of profit or loss statement under IFRS 18. And then we'll get to what the specified main business activities are. So actually looking at identifying and assessing specified main business activities, the implications for the different types of main business activities, and then we'll do a bit of a recap. And so let's look at a recap, quick one. As discussed in the January webinar, IFRS 18 was published to address 3 key concerns expressed by stakeholders to the ISB, and these were that statement of profit or loss currently varies from entity to entity in structure and content. In the notes, performance measures defined by management are useful, but entities are often not explaining how they're calculated and why they're important. And you can imagine from analyst perspective, they want to know how things are, what's included and what's excluded, and how these things are calculated. And in both primary financial statements and in the notes, information could be more appropriately and consistently aggregated and disaggregated. To address these 3 concerns, IFRS 18 actually includes the following 3 key changes to the current requirements in IAS 1. So in the statement of profit loss, the report now has 2 new defined subtotals, that is operating profit and profit before financing and income taxes. And the requirement now is to classify income and expenses into one of the 5 specified categories based on a new set of classification requirements. In regards to the notes, the disclosure of information about some of those management-defined performance measures is now more strict and more criteria-based. It also requires certain disclosures to actually enhance people's understanding of those. And in both the primary financial statements and the notes, groups items applying enhanced requirements for aggregation and disaggregation of information. And so that's been the fundamental changes under IFRS 18 from IAS 1. Now, I mentioned before those 5 categories. So IFRS 18 identifies these 5 categories of income and expense items and requires entities adopting IFRS 18 to classify each income and expense item into one of these categories, subject to the rules and requirements in the standard. And we've talked about some of those rules and requirements in the January webinar, and we'll talk about some of different ones today. The purpose of classifying income and expense items into one of these 5 categories is not to provide a subtotal for each of those subcategories. So that's really important to remember. IFRS 18 adds 2 new defined subtotals, neither of which directly relate to any of the individual categories. Now, I'll come back to this point maybe a bit later, but really the purpose of the categories is to guide what's included and excluded from the mandatory subtotals. I think it's a bit easier if I show, and I've used this slide in the last webinar, but if I look at this slide, you can get a bit better sense of what it means in that context. So classification of the income and expense items between the various 5 categories actually allows a structure of the P&L to be developed based on the subtotals. So those classifications effectively affect what is contained in each of those subtotals. So you can see what the ISB are trying to do with this standard is trying to produce a little bit more rigor around what items are included where in the P&L, and therefore in which subtotals they fall into first. I mean, obviously all income and expense items will obviously fall into the last profit or loss item, but in terms of the structuring and understanding where the different components are, this is one of the kind of fundamental concerns that stakeholders expressed to the ISB around what IAS 1 is currently doing, or how entities are currently applying IAS 1. And so IFRS 18 is effectively trying to provide more rigor around that classification, so you can get more consistency between entities and over time as to what they're putting in the various subtotals that they disclose. I provided this slide in the last webinar. It was to really maybe just to think more conceptually around how IFRS 18 works. So, if we work from the left to the right to the side, income and expense items, you have them, you then pass them through these new classification requirements and policy options, and they're categorised into one of the 5 categories. So operating, investing, financing, income taxes, or discontinued operations. Now, for most of the discussion to date, we've really been focusing on those first 3, operating, investing, and financing. We've sort of taken income taxes and discontinued operations as being sort of given because they're sort of very quite prescribed categories. But we will come back to those at some point in time and sort of talk about a bit more detail. But to date, we've been talking about operating, investing, and financing, and you can see that where they sit, you end up, based on the subtotals that are actually required now under IFRS 18, you're actually required to then categorise them, and that categorisation effectively then is going to drive what's included in those subtotals moving down the P&L statement. A little same sort of concept, but a little bit more detail. These new classification requirements and policy options, they're basically driven by three criteria. One is the nature of the income or expense. So if we talk about, for example, when talking about interest, I mean, that's a particular type of income or expense as compared to investment returns. And so the nature of income or expense item will often drive their categorisation. Whether the income or expense is specified in IFRS 18. So IFRS 18 goes to the point of actually saying certain parts or certain components or certain types of income and expense should be classified in certain ways into certain categories. And often the specified ones, if we talk about in terms of, say interest expense. Interest expense is often a specified one for types of assets or liabilities that are identified within IFRS 18. So to give a quick example, I think I talked about it last webinar. For example, DB obligation is identified as a particular type of liability. The interest expense that accrues over time for a DB obligation is a specified interest, and so therefore it has a particular treatment, and that's typically within the finance category. Last but not least is the entity's main business activity. Now that actually can drive from time to time the classification, especially if it's a specified main business activity. So the ISB acknowledges and says, look, everyone probably has a main business activity, but it's certain types of business activities that might change the way you present or classify certain incomes and expense items for the purpose of applying IFRS 18. And that's actually where and actually it's interesting, I think this is where the complexity starts. And so I think it's actually a good place to now just kick straight into that specified main business activities. I provided this in the last webinar. I talked briefly about the specified main business activities. Now, as I discussed in that webinar, if it's determined that an entity has one or both of the specified main business activities identified in IFRS 18, then some of the general classification requirements in IFRS 18 won't apply. So instead, some special requirements will apply to these categories of entities, which will result in certain income expenses, principally those related to investments in specified assets and interest, so whether it be interest income or interest expense, being classified in the operating category instead of the investing category or the financing category as applicable. So typically, under the normal general requirements, if you don't have a specified main business activity, your classification of things like investment returns or interest expense or income would tend to be recognised either in the investing category or the financing category. But as a consequence of introducing this specified main business activity, what that does is then it says, okay, these types of entities are slightly different, and the classification in respect to these items can change. And so that's how the ISB has operationalised this idea that we're going to apply certain different rules than what's applicable to the general cohort of entities applying IFRS 18. We're going to have special rules for these particular entities. So as you imagine, when in accounting standards, when we do that, if we actually say that this particular entity has different rules, then that actually puts quite a bit of pressure on those particular rules and the interpretation of those rules. I mentioned in the last webinar that the reason the ISB, and I'll just reiterate that, the ISB decided to have these separate rules for these entities is because if they applied the general approach that maybe I outlined in the first webinar this year, some income and expense items that they would regard as their ordinary operating activities would be presented outside of the operating results of these entities. So they wouldn't flow initially into the profit or loss, the operating profit or loss number at the top of toward the top of the P&L statement. which would probably seem inconsistent to them and probably inconsistent to analysts and other users of their financial statements, thinking, well, this is a part of their operating activities. To get a real sense of how they're performing, they should actually be a part of those operating category of income and expense items. And this probably just gives you like a mental map about how it sort of works. So the idea that there are certain rules, like the broad IFRS 18 model applies, and this is what your P&L would broadly look like, and this is how you categorize your income and expense items. But there are probably, just for those entities with a specified main business activity, some of the items investing and or some of the items in financing would actually be moved up to operating. Now, obviously, when I mentioned probably just briefly, but the idea is when we start introducing rules and exceptions, that does put pressure on those rules and exceptions, because what it does often is that there'll be an element of interpretation, there'll be an element of sort of assessment that you need to do, and making that determination then will have a significant impact on the outcome. So imagine if you do fulfill this criteria. So if you've got an entity that does fulfill this criteria for specified main business activities, what it's going to do is make its P&L look a lot different than perhaps what it would otherwise. So let's actually move into that and have a sort of think about and look at some more of the detail. Now, the assessment of whether an entity has specified main business activities is actually a matter of fact, and it's not an assertion or an accounting policy choice. Now, for those of you familiar with the investment entity classification in AASB 10 or IFRS 10, the assessment of whether an entity has a specified main business is similar in the sense that it's not optional for an entity to choose whether it has a specified main business activity or not. If you conclude that an entity, like if you're under AASB 10 and you conclude that an entity is an investment entity, it actually has to apply investment entity accounting. So if you conclude that an entity does have a specified main business activity, it's actually required to apply the requirements for entities with those specified main business activities. Now, having said that, because there are no quantitative criteria and we have a qualitative criteria such as the word main and business, assessing whether an entity has specified main business activities may, from time to time, actually require a bit of judgment. Now, IFRS 18 notes two sources of evidence and I've identified these in the slide, that an entity may use in assessing whether the entity has a specified main business activities. Now, these are use of subtotals as an indicator of operating performance, including indicators used outside of the financial statements. Now, if an entity uses a particular type of subtotal as an important indicator of operating performance, then the existence of a specified main business activity is likely. It's interesting. This is an unusual thing for the ISB, but it's a difficult concept to try and operationalise the notion of specified main business activity. And so it's interesting the ISB are actually sort of leaning on what is management's behaviour in the past and what have entities done in the past a little bit, and saying, well, okay, if there's some evidence in the past to indicate that they have collectively put this number, let's just say for the sake of the argument, it's interest income. If they've included interest income in the operating sort of section of their P&L, then maybe that's indicating that that income or expense is a part of that main operating business, the main specified business activity that they've got. These subtotalers would be similar to gross profit, so it's not surprising you'd find things like, and it's one of the ones that the ISB does refer to quite often is the notion of net income or net interest margin. Sorry, net interest income or net interest margin. Those subtotals are very common amongst banks, and you'd probably conclude that a bank in most cases is an entity that's got a main specified business activity of providing finance to customers. The evidence that subtotals similar to gross profit are important indicators of operating performance also includes using the subtotals to explain operating performance externally. So often you'll see the publications to the market and the reports to the market maybe the entity makes, if it's a listed entity, might include these numbers. And it might include these numbers because there are people outside of the entity that consider these numbers strong indicators of their performance. You might also find evidence that they use these numbers internally. So if you're looking at the board pack and you see that there are some certain KMP that are assessed and evaluated, their performance is assessed and evaluated based on these particular performance measures, particularly something like net interest income or something like that. That might also indicate strongly that that is a main business activity, or that it's linked to a main business activity in the sense that it's actually very relevant to the operating performance. The second criteria, or sort of broad criteria that the ISBI identified as the IFRS 8 operating segments and the disclosures entities might make under these. Obviously, not every entity applies IFRS 8. IFRS 8 is only really applicable to those entities that are either their instruments are their financial instruments, their equity or debt instruments that they issue are either listed or about to be listed on a market. So as a consequence, IFRS 8 may or may not be the best indicator for some entities when they're trying to assess their main business activity. So if you haven't prepared operating segments before, then obviously it's not going to be a strong indicator of whether you are or aren't, or do or don't have a main business activity. But for those entities that are listed, it actually is quite revealing. So information about segments may provide evidence of either or both specified main business activities. However, this is only relevant, as I mentioned then, to entities applying IFRS 8, so listed entities. Now, if an entity does apply IFRS 8, I think the key thing you probably need to be alert to is the distinction between a reportable segment, which if comprises a single business activity, and that's again, we're sort of looking for a main business activity, so we're looking for a single business activity. If it's got a single business activity and it's a reportable segment, that might be strong evidence that the segment performance is important to the entity performance. But when you talk about operating segment, if it comprises a single business activity, evidence that the business activity might be a main business activity of the entity. For those of you who haven't applied IFRS 8, IFRS 8 it sort of works in levels. So you can identify operating segments, but you might not, those operating segments may not be sufficiently large or material from a segment perspective to actually warrant separate disclosure. So as a consequence, what you might sometimes find is reportable segments will often combine operating segments. And so as a consequence, if you see a reportable segment and it's a single business, that might help to explain or direct your attention to the fact that there is a main business there. If you're dealing with an operating segment, it's probably not large and therefore may not be main in that context. And it might also, as a consequence of the way that IFRS 8 works, is it might also be basically aggregated into with other operating segments to create a reportable segment. I think just a couple of comments there. With regards to the evidence of subtotals, IFRS 18 doesn't include examples of subtotals. So it does make reference, and I mentioned before, like, common one is the net interest income or net interest margin subline. But if IFRS doesn't actually include those examples, it's difficult to use them as an important indicator. So you need to be careful about sort of assuming that certain indicators or certain subtotals are indicators of the main business activity. However, subtotals similar to gross profit are common in certain industries, and I mentioned there banking is a common one where you often see it. Sometimes you might see it in funds management as well. So if there are certain common subtotals and you see them, they're used as part of that sort of operating performance assessment process. So it's just disclosed as a part of performance, or that used in a way that indicated that that certain parts of the business or certain individuals within the business are going to be assessed in accordance with that behaviour. Their performance is going to be assessed based on those subtotals. Then you could probably use those as a basis. Now, it's not to necessarily say that that is actually going to mean that there is a specified main business activity. It just means that it's directing your attention to that and should give it more consideration. I mentioned before, with regards to the role and relevance of operating segments, IFRS 18 is a bit less definitive, which is understandable because it doesn't apply to everybody that IFRS 18 applies to. If a non-reportable segment comprises a single business activity, it's possible that there may be that operating segment's performance is an important indicator of the entity's performance. And therefore, the business activity of that segment may be a main business activity of the entity overall. But IFRS 18 doesn't deem this to be the case, as it does for, say, reportable segments. So you need to sort of really focus on reportable segments, maybe consider operating segments, but understanding that if an entity has made an appropriate assessment under IFRS 8 around their reportable segments, then you would be focusing on those reportable segments as opposed to maybe the non-reported operating segments. So maybe let's look at a sort of a worked example. This is actually a real example, but let's just sort of, imagine, and I'm not obviously going to give the name of the entity just for the sake of interest, but let's just look at a practical example, maybe just sort of, see if we can flesh out from it whether or not there's a specified main business activity here. So I've provided there an income statement. You can see there that there's revenue. You keep working your way down. You can see some funds, investment income. So it's interesting that could mean one of a couple of things. It could mean that the entity is actually investing in assets. for others, or it could actually mean that it's undertaking investment service activities. So just need to be conscious of the fact that just because you're looking at the way certain things are described in the P&L might not necessarily be a true indicator of or a useful indicator for your purposes to identify a specified main business activity. We work way down the P&L. You can see their net gain or loss on investments in fair value through profit or loss. Now, it's interesting, that could be any number of different types of investments. And then you've got the sort of standard employee costs, development costs, and so on, administration. There's also mention there of share of net profit from equity investments. So that's useful to know because that might have some implications for around the specified main business. So based on the format of this pre-IFRS 18 profit or loss, you might consider operating profit subtotal includes revenue, so the property investment. And I'm just telling you that it is property, there is some property investment in there. Some fund investment income and gains on investments at fair value through profit or loss. So entity potentially could be investing in 2 or more groups of assets as a main business activity. It's important that that's it, that, when you're actually making that assessment around whether an entity is specified main business activity is investing in assets, it's not assets generally. You have to actually consider the specific types of assets, and the assessment is based on the existence of specific types of assets, which are the main business specified main business activity of that entity. So it's not just generally investing assets. There has to be some specific assets that are their main business activity that they're investing in to get that classification. You consider the gains and losses on investments at fair value through profit loss would otherwise be classified as investing activities, so presented below the operating profit subtotal. So the ISB guidance in IFRS 18 was talking about, is the entity doing something now that would indicate that maybe the certain line items, so investment income or returns, are being treated as an operating number, and therefore maybe that could indicate to them that that's a main business activity. Then they're trying to elevate that, the significance of those numbers to their investors, because that is significantly what they're being assessed or judged on. And you might also consider investigating further whether the operating profit or loss number is reported internally, maybe at monthly board packs or externally, so as a part of analyst briefings. So when you pick up a P&L like that, you can usually tell some things from it, but effectively what you're probably going to need to do is work a little bit harder and sort of give an understanding about what exactly is underlying some of those numbers to make that determination around specified main business activity. If we had a look at their segment report, so based on these operating segment disclosures, you might conclude that if the entity holds substantial balances in, say, property, you might conclude that the specified main business activity of investing is in property. So you can see actually there, and one of their reportable segments is property investment. Now I'm assuming, and I know for a fact, I saw the balance sheet as well. But I know that the balance sheet includes some investments in property, but also in vehicles that hold property. If there are investment vehicles that hold property, you might also conclude that it has a specified main business activity investing in investment vehicles. So that could be a different specified main business activity, but a main business activity nevertheless. And it's interesting that they've got a third column there for funds management. Now that could mean that they're investing in debt or equity instruments, so you'd need to consider their balance sheet. But you might also have to consider whether or not they are actually providing funds management services. So they're actually providing investment advice, and that those revenues are, in fact, some of them are actually for services. Now, if that's the case, if some of this revenue, and it's almost as large, the funds management arm is almost as large as the property investment in terms of returns. If the funds management is not holding assets, then it doesn't have, the income is not being generated from assets, it's being generated, say, from services, then that particular column or that particular part of the business wouldn't qualify for classification as a specified main business activity of investing in assets for that reason, notwithstanding there's sort of some relationships there. Have a looking at now, if we just sort of swing over to providing financing to customers. I've done the same here. I've picked up a bank's some information from a bank. I won't say who bank it is, but I'm sure if you wanted to try and work it out, you could probably do it given the operating segment disclosures. You can see from this extraction that you might conclude that the entity is actually providing net interest income as a subtotal, as an indicator of the operating performance. Now that's a common feature of banking and lending institutions, and so it's not surprising you might then start to think, okay, this entity is possibly or very likely got a specified main business activity of providing financing. Now, IFRS 18, paragraph B 32A actually identifies banks and lending institutions as examples of entities providing financing to customers as a main business activity. And so as a consequence of that, it might also lead you down the track of thinking, okay, this entity potentially is going to classify it as providing finance to customers as a main business activity. If we turn our attention to the operating segment disclosures, they again suggest the entity is providing banking and lending services across a range of jurisdictions. So their operating segments are not people or necessarily markets. Their operating segments are jurisdictions. So you can see there Australia, commercial retail, institutional, New Zealand, Suncorp, Pacific, and so on. So as a consequence of that, this information, again, within the operating segment disclosures, you can see the net interest income, you can see net fee and commission income, you can see other income. So again, those line items tend to indicate to us that not only are they investing in loans, so probably borrowing money and lending money to customers, that's a part of their business. That's a main part of their business. It's a big significant part because it's quite high up in there, both in their line items in their P&L, but also in their operating segment disclosures. Now, what hopefully I've done to date is maybe planted a seed, which I hope have planted a seed as to understanding exactly how to apply this this specified main business activity concept. I think I mentioned in the previous webinar that there is some complexity in IFRS 18, and some of that complexity relates to if-then questions. So the idea that if you've got certain features, you can do this, or you have to do something else. Now that can make complexity because you have to think about, the existence of certain factors which are relevant to that criteria. Another thing I think, and it's probably quite a significant thing that creates complexity in IFRS 18 and applying IFRS 18 is this notion of levels. So if anyone listening to this has actually ever read anything by maybe James Gleek or Stephen Jay Gould, talking about levels of abstraction within nature, often when you move through levels of abstraction, and so I'll give you an idea about levels of abstraction, you might talk about an individual organism, you might talk about the family that the organism belongs to, or the wider genus or kingdom that individual entity belongs to. When you move up through those levels of abstraction, sometimes things get more complex. And so and the complexity often leads to the fact that you can't necessarily explain what's going on at a higher level based on what you understand what's going on at a lower level. And I give an accounting analogy. Obviously, a really simple one is that when we prepare consolidated financial statements, we don't do push-down accounting. So as a consequence, what we see is when we look at the subsidiaries, the acquired subsidiaries numbers, they are as they were when they were purchased. When we consolidate them, we uplift them. And we also can potentially get things like goodwill and gain on bargain purchase and these sort of things. So those things are not predictable necessarily from the subsidiary level. And IFRS 18 sort of works the same way, because if you've got to make an assessment, and this is where it comes to the first slide here, the level of assessment, in both initial and ongoing, it actually has to be formed at the reporting entity level. So the first thing it is you need to do when you're trying to apply IFRS 18 is understand who are your reporting entities within your group. Because I've got to make that assessment at the reporting level. I've got to work out who within my group is going to separately prepare financial statements under IFRS 18. And in that case, I'm going to have to make an assessment about them at each of that level. So to give an example, so let's say, and this is a pretty common corporate structure we see in Australia. So, and interestingly, I'll try not to give the game away, but interestingly, I often see that intermediate parent entity as often being a financing entity. So it often borrows money, and that's its only purpose, and it borrows money, but then in turn then distributes the money to maybe the subsidiaries, which are operating entities. But if we start the level at the ultimate parent entity, you'd say, okay, well, if I look at the ultimate parent entity, I've got to make an assessment about its financial statements. Now, I've got to ask myself, is it preparing consolidated or separate financial statements? If it's preparing separate financial statements, then the assets that it's holding in its balance sheet are probably going to be slightly different or of slightly different nature than what they would be if they prepared consolidated financial statements. So I've got to make an assessment about, okay, if I'm looking at an ultimate parent, is its main specified main business activities investing in other entities, or is it something else? And you need to make that. That's obviously that's an assessment of fact. You have to look at the balance sheet, have to look at the operating activities of the entity, get a sense of what it's doing. But that assessment, you might, for example, let's say for the sake of this argument, we conclude, look, it carries all of in its separate financial statements, it carries all its investments in subs at cost. It doesn't have any other assets really. It's just got these investments in subs, and that's its main business activity. So it may be the case that we're going to assess this one as having a specified main business activity of investing in assets. Let's just leave it at that for the time being. If I now look at the intermediate parent and just say, for the sake of the argument, the intermediate parent is the parent that borrows money for the group. Now, if that's its only purpose, you might conclude that its specified main business activity is, and within just that entity, its specified main business activity might be borrowing funds to finance customers, because its customers are sub A, sub B, and sub C, and possibly ultimate parent as well. And so immediately, I'm going to have potentially two different specified main business activities in the one group. If I then actually prepare consolidated for the intermediate parent group, and maybe I don't prepare individual financial statements for sub A, B, and C, I may have the issue then that I've got a specified main business activity of providing financing to customers, and that's sitting in the intermediate parent. But sub A and B and C might actually just have they might be operating entities. Sub A might, for example, produce widgets. Sub B might, for example, lease cars. Whatever it is, you are faced with the potential that you're going to get a different assessment and therefore potentially different accounting involved, subject to how you draw your, how you ring fence your various entities within your group for the purpose of financial reporting. And then ultimately, obviously, if we combine that all together and we actually say, okay, but when we prepare consolidated financial statements, we have to then make an assessment about is there still a specified main business activity of the entities or not? And it might be the case that, for example, when you consolidate an ultimate parent entity, all of those investments in subs disappear and they're replaced by all of the underlying assets in the subs. So as a consequence of that, you might then that initial assessment for the ultimate parent that it's investing in assets as a specified main business activity, you might then conclude, well, actually that's not relevant for the group. But I still have this issue of the intermediate parent. It's actually borrowing money. And then when I put that together and I thought, well, actually, no, maybe really when I look at the group, the bulk of the activities is really being conducted by sub A, B, and C. And those subs are operating subs. And really this is just borrowings. There's no customers because I'm preparing a group account. So therefore there's no distinction between the parent, the intermediate parent, and all the subs. And therefore I'm now looking and going, well, actually now when I do it at a group level, maybe I don't have a specified main business activity. Maybe I'm just in the general requirements of IFRS 18. So there's a level of complexity that you've got to deal with when you're first thinking about, okay, how am I going to apply IFRS 18? Now, I sort of alluded to it in the previous slide, but again, let's just explore the idea of, okay, we've got multiple main businesses within it. So it could be the case, and I sort of alluded to in the previous slide, is that the ultimate parent invests in assets, and that's just because that's all that's sitting in its balance sheet. Now, if we go down to the sub, and we find, and I'll give you a bit more information here. So imagine sub A provides financing to customers. So it is actually a lender. And so, okay, well, if I'm preparing the financial statements for sub A, I have to look at sub A and say, okay, fair enough. That's what if I determine that its main business activity is providing financing to customers, then that's the classification for the purpose of applying IFRS 18. If I prepare separate financial statements or individual financial statements for sub A, I can do the same for sub B and C. But obviously with sub B, I look at them and I say, well, actually what it does is manufacture equipment. So it's probably not have a specified main business activity of investing in assets, because typically if you're doing manufacturing, those assets are not going to be able to individually or separately provide you returns. Generally, you put the assets together and it generates product for sale. So we probably conclude that that's not investing in assets for as a specified main business activity. And then we look at sub C and we go, provides the lessor services to sub B. So interestingly, maybe it's got an investment property, and maybe that it's just an entity set up to hold the property, the manufacturing property of that sub B uses. And for whatever reasons, they've just structured it this way. So you might conclude sub C actually does invest in assets to make returns, because it's actually holding maybe investment property for the purpose of sub B. If you then go up another level, you might again, as I alluded in the previous slide, you might conclude that, okay, the intermediate parent, because it's predominantly there to borrow money for the rest of the subs, then if it's preparing separate financial statements, I might conclude that it's got a main business activity of providing finance to customers. However, when I put them all together in that sort of subgroup account, if I'm then preparing financial statements for the intermediate parent and the immediate subs, I've got to make an assessment about whether or not that that main specified business activity of the intermediate parent, is it still main of the business, or are now we were talking about the idea that actually when I put all these things together, what happens is that sub B manufactures equipment, sub C sells it to customers and provides financing. Then I've got a question of, actually, have I got financing as a main business activity, but as a consequence of sub A, not as a consequence of the immediate parent? And again, we have to think about what's the main activities. We have to use the criteria in IFRS 18 that sort of directs us to, what are the things, how have these entities reported previously? What do we assess as being the main activities? How much of how much revenue is being generated from these things? How significant are the assets or that are related to them to the various entities? Now, if I can add another level of complexity, identifying classes of assets that qualify an entity as investing in assets as a specified main business activity. So I hinted at it before, the idea that this classification doesn't come about from just investing. So it just doesn't mean that, look, I hold all sorts of different types of investments and I just invest. What it does is require you to make an assessment about certain classes of assets and whether or not they are the specified main business activity of investing assets. Are they the assets that are generating the main returns? And are they the main focus of the entity? Because when it comes to the rules within IFRS 18 and the treatment of the various the investment income and expenses that it might be moved from, say, investing activities to operating activities, you have to be aware that it's not going to apply to all the assets. It's only going to apply to those assets that are assessed in conjunction with the specified main business activity assessment to be part of that main business activity. So just working through the slide, an entity may conclude that its main business activity is investing assets, notwithstanding not all the assets held by the entity are held for this purpose. Only those assets that generate a return individually and largely independently of other assets can give rise to the specified main business activity of the investing in assets. So it's not just investing in assets generally, it's investing in specific classes of assets. IFRS 18 doesn't distinguish between the classes, except to say that the asset that you invest in that gets you to the point where you're considered to have a specified main business activity of investing assets, those assets must be able to generate a return individually and largely independently of other assets. You can't conclude that you've got a specified main business activity if you've got a whole lot of property, plant, and equipment that you use for manufacturing, because those assets aren't necessarily going to generate a return individually and largely independently of other assets. And IFRS 18 is very clear on that one. So when making the assessment, it's performed on an individual asset or group of assets with a shared characteristic. So accordingly, say for financial assets, consistent with the classes identified in IFRS 7, paragraph 6, or for parent entities, investments in other entities, consistent with the measurement categories in IAS 27, paragraph 10. So if you're looking, for example, at the ultimate parent, you might look at their balance sheet and find that they are carrying a whole bunch of investments in subs, and they're all carrying them at, say, fair value through profit and loss, because in the ultimate parent in this case actually qualifies as an investment entity. And so we might say, okay, well, the ultimate parent is investing in assets. It's its main business activity because it doesn't have any other assets. It just holds investments in other subsidiaries and therefore, derives dividends and other returns from them. And so as a consequence, we might then conclude, okay, its specified main business activity is investing in assets, but specifically in those subsidiaries. So, implications. Now we think about the requirements, the general requirements. So I'm going to go back one step and talk just briefly about the general requirements of investing category. So under IFRS 18, it identifies basically three types of assets. So your investments in associates, joint ventures and unconsolidated subsidiaries, cash and cash equivalents, and other assets if they generate a return individually and largely independently of the entity's other resources. Now, if you're an entity with non-specified business activities, the classification of these requirements are quite strict. So you don't get much choice. So when it comes to, for example, any of these types of investments, or any of these types of assets, the specified income and expense related to these items actually is recognised in the investing category. So there's no choice. It's just what it is, because you don't have a specified main business activity. If we now look at what the implication of a main business activity investing in assets does, this slide, and rather than trying to go through the requirements in the standard, which are quite complicated and quite wordy, thankfully BDO Global have prepared this great little decision tool, which I'm going to use right now. So if an entity invests in assets as a main business activity, the general classification requirements are of IFRS 18 are modified. Now, I mentioned that previously. The classification requirements applicable to assets and related income and expenses of entities with a specified main business activity of investing in one or more classes of assets are actually really summarised in this slide. If we work our way through this decision tool, the key requirements applicable to entities identified as having a specified main business activity of investing in assets are basically as follows. So if we start from investments in associates, joint ventures and unconsolidated subsidiaries, I'll come back to the treatment of cash and cash equivalents. So I've left that one out. It's on the far left. I'll come back to that one because it has there's a little bit more to that one than can be sort of accommodated in this slide. If the entity holds any of these types of investments, so investments in associates, joint ventures, and unconsolidated subsidiaries, and they are accounted for using the equity method, then the income and expenses arising from these investments are classified in the investing category. Okay, you don't get a choice. If the equity method is applied, it goes to the investing category. And this is probably important just to highlight this. If you compare it to the previous slide, entities with a specified main business activity investing in assets are also required to classify income and expense arising from equity account investments in investing activities. So it's irrespective of whether an entity has a specified main business activity investing in equity accounted investments or not, if the equity accounted investments, if the entity accounts for the investments using the equity method, then all the income and expenses are classified in investing activities. So now if we answer no to that question, so no to the question in the middle there, is the investment accounted for using the equity method, we need to remember that there's an exemption provided in IAS 28 for entities that are held directly or indirectly by venture capital organisations, say mutual funds, unit trusts or similar trusts. So if an entity does hold an investment in an associate, joint venture or an unconsolidated subsidiary, and they actually don't apply the equity method to those investments, then you have to consider whether the entity is actually investing in these assets as its main business activity. So remembering that investments in associates, joint ventures and unconsolidated subsidiaries would all qualify as assets that generate a return individually and largely independently of the entity's other assets as a main business activity. And if the answer to that question is yes, the entity does invest in these types of assets as a main business activity, then the income and the expenses arising from these assets are actually classified in the operating category. If not, then the income and expenses from those investments are actually then classified in the investing category. So if we're working across now to the other assets that generate a return individually and largely independently of the entity's other resources, so remember I mentioned earlier, these types of assets might include investment properties and equity and debt financial instruments. We have to answer the question, is the entity investing in these assets as a main business activity? If so, income and expenses arising from these assets is classified in the operating category, consistent with those income and expense items arising from the entity's specified main business activity, and therefore represent normal operating activities of the entity. However, if the answer to this question is actually no, then the income and expense items are actually classified in the investing category. Now, last but not least, we have all the other assets, which comprise assets that don't generate a return individually and largely independently of the entity's other resources. So like, for example, plant and equipment or inventories, intangible assets, trade receivables, those sort of things. So income and expenses arising from these assets are by default classified in the operating category. Okay, so when you have an interaction between the IFRS 18 and the specified main business activities, you need to think about what's the main business activities and particularly what are the assets that are considered to be the basis of the entity's main business activity, because they're the ones whose income and expenses are going to be reclassified. So we move to financing. I think I provided this slide at the last webinar. As always, when an accounting standard distinguishes between items, the purpose is typically to facilitate different accounting requirements to be applied to different categories of items. So when it comes to the financing category, this is no exception. You can see in the slide, IFRS 18 actually distinguishes between liabilities that arise from transactions that only involve the raising of finance from all other liabilities. And you can see there that what happens is effectively those liabilities arise from transactions that involve only the raising of finance, have those features as listed there. And if it doesn't have those features, then it's outside of that category. Now it's important because, and again, I shared this slide I think in the last webinar, really what happens is effectively, so if liability arises purely from financing, then typically the income and expenses are associated with it go to the financing category. If you've got liabilities that arise for not just, or doesn't just involve only the raising of financing, then you've got to basically consider the split. So there's some specified income and expenses which go to the financing category, and everything else goes to the operating category. And that's reflective of the fact of what's underlying these assets, these liabilities. So for example, a provision for make good. You can have interest on that provision for make good. Now the interest is specified under the IFRS, so as a consequence, the interest expense will go to the financing category. But shifts in as a consequence of changes in the estimates of the costs associated with the provision, the future costs, that's going to be recognised in the operating category. There's some exceptions in there. I haven't covered those to date because they add a complexity. I think at this stage we might just pass over. So, if an entity provides financing to customers as a main business activity, effectively the same principles apply as to the situation for entities with investing in assets as a specified main business activity. That is the general classification requirements of IFRS 18 are modified. Now, the classification requirements applicable to liabilities and the related income and expenses are basically summarised in this slide. For something different, let's start from the right-hand side of the slide and I'll work across to the left, and I think you'll see why I'm doing that when we get to the end of it. As with the discussion of cash and cash equivalents in relation to entities with specified main business activity of investing in assets, let's park this one for a minute. Again, there's some nuances associated with it that can't be sort of explained fully in this slide, but I'll explain them further in another slide later. The classification of interest arising from cash and cash equivalents for entities providing finance to customers is actually intertwined with the classification of interest arising from cash and cash equivalents of entities that invest in some assets as main business activities. So that's why I sort of want to park it for the time being. I'll come back to it, I promise. So then we move across to income and expense arising from liabilities that arise from transactions that do not involve the raising of financing. So, or not only the raising of financing. We talked about it, I've just talked about it as well. These liabilities, they include payables for goods and services, contract liabilities, lease liabilities, defined benefit pension liabilities, and provisions. So the similarities or the common features of all of those liabilities are that you're probably getting a good and service along with some financing. And so as a consequence, this is what IFRS 18 does. It tries to separate the financing component out and treat that as a financing component. And if there's another component, which is more about services or goods, what that's doing is then pushing it out into the operating segment. So all entities under IFRS 18, irrespective of what their main business activity is, classify specified income and expenses arising from those payables, contract liabilities, lease liabilities, DB liabilities, provisions in the financing category, and all other non-specified income and expenses in the operating category. So that doesn't change with specified main business activity. Now, if we move across to the left-hand side of the slide, you can see that for entities that provide financing to customers as a main business activity, liabilities arise from transactions that only involve the raising of financing. You need to further subcategorize them into liabilities that relate to providing financing to customers and that don't relate to providing financing to customers. So basically, entities that are providing financing as a main business activities, for those pure financing liabilities, they relate to providing financing to customers. Associated income and expense are always classified in the operating category. However, and this is a practical issue. So sometimes, and you could probably imagine it, there would be circumstances where banks, or any bank or any entity that is involved in lending, they might borrow money from a lender for multiple purposes. They just go to them and say, we want an X million dollars worth of loans. To provide, and some of that financing might be used to provide financing to customers, and some of it might be used to acquire, say, a new information technology system. And in these circumstances, the entity actually has an accounting policy choice to classify the related income and expenses in relation to that liability, that pure financing liability, in either the operating category or the financing category, but it's subject to criteria, and I've provided these criteria in the next slide. So these criteria, to some extent, let's go walk through them maybe. Criteria 1's probably easier to understand than criteria 2, but I'll provide some more explanation around criteria 2. So criteria 1, if an entity cannot distinguish between the liabilities that relate to providing financing to customers and the liabilities that do not relate to providing financing to customers, the entity is actually required to classify the income and expenses from all such liabilities in the operating category. So effectively what happens is if I'm borrowing money, pure financing, I'm borrowing it in part for providing financing to customers, but in part for buying PP&E. And I can't make the distinction. It could be because I don't have the systems at the level in my entity that allows me to make that distinction. Like it might be fed up through budgets, which nobody knows what ultimately the number sort of comprises at the very top of the entity. So as a consequence of that, you might say, look, at the top of the entity, I can't make that distinction. So therefore, I'm going to have to, effectively having the borrowing for PP&E taints the borrowing as a whole, and therefore I need to treat the income and expenses in the operating. If, however, the entity can make a distinction, so if a pure financing liability is not used to provide financing to customers, the entity can apply an accounting policy choice to classify income and expenses in operating or financing, provided that the entity doesn't invest in financial assets as a main business activity. Now, this is where the complications arise, but it's that idea that there's an intertwining between certain accounting policy options within specified main business activities requirements. Now, if the entity does invest in financial assets as a main business activity, the accounting policy choice made for income and expenses arising from the pure financing liabilities not used to provide financing to customers must be consistent with the choice applied to cash and cash equivalents. So what does that mean? Thankfully, again, BDO Global's provided us a really good little decision tool for this. So I'll walk you through it. It's actually, I think this is really an excellent summary of the considerations required when you're actually faced with that situation where you've actually got both specified main business activities. So you're both, within the group, and you typically imagine it's within the group. Although there can be situations where you invest assets and lend money, but when you've got two specified main business activities in the one reporting entity, how do you deal with it? How are you thinking about it? So I think this is a really useful tool to think about it. I'm going to go Western conventional and start from the left-hand side this time of the slide. So firstly, an entity that invests in financial assets as a main business activity will always classify income and expenses related to cash and cash equivalents in the operating category. This conclusion remains unchanged even if the entity invests in financial assets as a main business activity and it provides financing to customers as a main business activity. So it has more than a single specified main business activity. So if it does both of those things, it remains unchanged. And if you think about it, and I won't dwell on it too long because obviously conscious of time, but when you think about it, if you're investing in financial assets, cash and cash equivalents is just another financial asset. And so and it's going to be difficult to make that distinction between within your cash and cash equivalents, what cash is a result of the financial assets and what's the result of everything else. So as a consequence, it's always going to be in the operating category because it's the default category. Secondly, if an entity doesn't invest in financial assets as a main business activity and does not provide financing to customers as a main business activity, income and expenses related to the cash and cash equivalents will always be classified in the investing category. So in this case, if I answer no to the question, does the entity invest in financial assets as a main business activity? And also answer no to that next question, does the entity providing financing to customers as a main business activity? I always end up in the investing category, and that's that box in the bottom right-hand corner. So thirdly, where an entity does not invest in financial assets as a main business activity, but does provide financing to customers as a main business activity, it's got to determine if the income and expenses related to cash and cash equivalents relate to providing financing to customers. Now, if they do, income and expenses are classified in the operating category because that's the specified main business activity and you can identify the cash as a result of that. So that's all related to your business, your specified main business activity. But if you can't, then you've got an accounting policy choice to classify income and expenses either in the operating or the investing category, subject to the two restrictions I've discussed in the previous slide, which are if you can't distinguish between cash and cash equivalents that relate to providing finance to customers and those that relate to the entity that don't, you're required to classify the income and expenses from all cash and cash equivalents in the operating category. Alternatively, you've got the accounting policy choice as to whether to classify interest income and expenses from cash and cash equivalents, but it has to be consistent with your accounting policy choice that you selected in respect to your pure financing liabilities that don't relate to providing financing to customers. And so there, hopefully, I've provided a summary, and I'm sure it feels like I've probably gone through it relatively quickly and at a high level, but I wanted to just convey to you, obviously, providing the slides as well, you can go back and work through them, but I just wanted to convey the levels and complexity that's required in implementing IFRS 18, particularly up front. So that actually takes me to the recap and additional considerations. I was just thinking when I was putting together the slides, I realised that there was an attendee question from the January webinar, and the question was, when is the best time to commence transition? And there was another question, what should finance teams prioritise? And I thought I might recap on that one because I probably didn't respond to that question at that time fully because I didn't really have the materials. I hadn't presented the materials in a way that necessarily been able to articulate the answer that I wanted to articulate. But that is, yep, start as early as possible. Obviously, ideally, yesterday is always good. You need to start with assessments around reporting entity, the specified main business activities, and if applicable, groups of assets subject to main business activity. So that's basically slides 23 to 25 of this webinar. There's a little bit of chicken and egg there, and I will admit that in doing this assessment, it will lead you to start to ask the question, well, what options do I have and what options do I want to accept? But I think you have to establish very clearly up front where, if there are any main business activities, specified main business activities within your group, and are they sitting within an entity that has to prepare separate financial statements? And if you have multiple specified main business activities, you need to think about what the implications are when you start to elevate up through the group and maybe prepare group accounts. I've said this over and over again, I'll just say it in this context as well. Prepare good position papers to document steps, assumptions, explain conclusions. You can imagine you're not going to be able to verbally explain this to an auditor. You've made an assessment, you've worked through your specified main business activities. There's absolutely no way known you could verbally explain it to them. You need to document it. It needs to be physically documented, and it needs to be provided to your auditor to get it, even to move forward in this transitional process. Like you need to, and another thing I would say is that there's something that you really need to engage with the auditors with on early. You can't assume that they're going to turn up on the 1st of July and simply just be handed something and go, yep, that's fine, we'll walk on. Yeah, it's something that you really need to engage with. And if you're struggling with it, engage with a trusted advisor like BDO to assist. The couple of things other things I just wanted to call out. Be aware of the accounting policy choices made under IFRS 18, paragraph 56B2, so that income and expenses arising in cash and cash equivalents. There is actually an impact on classification of income and expenses arising from certain derivatives. Now, I didn't go through it here in this. Again, I think you can compartmentalize it, but I just wanted to call it out to say, look, you need to consider that obviously you've made some certain policy choices if you have in respect to income and expenses around cash and cash equivalents. You need to be aware that if there's certain derivatives you have that meet certain criteria, then that will have implications for the accounting treatment of them as well. I will also mention we did receive quite a few questions probably in the last week or two around IFRS 18 and its application to not-for-profits and other entities, superannuation entities and so on. We did cover this in the January webinar, but do note that the AASB has got ED 338, application of AASB 18 and AASB 107 by super and not-for-profit entities and operating cash flow reconciliation. It's actually out and looking for comment at this point in time. So if you're interested in understanding what the AASB is thinking about there, I mean, they themselves are actually trying to seek input from people on that. So if you're interested in that, that's where that is at the moment. What the AASB's determinations with that, obviously, it's up to their determinations and the deliberations they have over the next couple of months and their discussions with stakeholders to understand what they're going to do. So, but we'll keep you up to date as that moves along. As we always do, question we was put to, do you need assistance? I mentioned, I'll just mention it again, the BDO Global publication's just been renewed and reissued. It's available on the internet, free of charge. It's a really good document. Some of the really good decision tools that I've used today in the slides, I've taken directly from that. Mention again the IFRS masterclasses, the virtual masterclasses we're going to hold in the next couple of months. We're going to walk through some work examples and work through some real scenarios and how entities are applying IFRS 18 and the kind of issues that they're faced with it. And we're not going to talk directly about the assessment of specified main business activities. Again, we might work into that one maybe in the second half of the year when we've got a bit more clarity on and everyone's got a bit more comfort around the actual general requirements just applicable across the board. We obviously have our corporate reporting and insights. If you're not subscribed to that, we do a lot of publications on IFRS 18 in those publications. I wrote one for the last month's IFRS and corporate reporting insights. So there's a lot of back articles that you can basically you can access through that publication. We have an education and learning hub that's very, very useful if you're looking for education, both on IFRS 18, but also on all of the accounting standards, available there to be accessed online. We do, as I mentioned before, we do provide accounting advice. We do provide it across the board to a lot of entities, and we are starting to see entities starting to engage on IFRS 18 and starting to talk to us about IFRS 18. So if you do have any IFRS 18 concerns, questions, just reach out. I wanted to also mention our BDO Lead dashboards. So we do provide BDO Lead, which is a lease management system that we provide both as a software solution, but also as an outsourced lease management system. The BDO Lead dashboard actually sits above the BDO Lead software and provides more operational sort of summaries of the numbers that are provided in BDO Lead. It's really useful for entities that don't have their own deployment of BDO Lead as a software, but are looking to use it more effectively to manage their leases operationally. Just in terms of reaching out, obviously I've provided there some of the names. There's myself in Leadab in Melbourne, but we've got Lynn in Adelaide, Kevin in Sydney, and Clark in Brisbane. Sustainability reporting, I thought I'd just provide some contact details if you are facing sustainability reporting. If you are a Group 2 entity and you're looking down the barrel, obviously Aletta, she's in the Melbourne office, Kevin is in the Sydney office, Tom Hogman, he's located in the Brisbane office, and Ashley Woodley is located in the Perth office of BDOs. So that's it for today. Hopefully you got something from the presentation. Certainly, I suppose the key thing I was trying to convey is that IFRS 18 can be complex, particularly if you've got specified main business activities. And so the time really to start to transition right to that standard is right now. Anyway, enjoy today and enjoy the rest of your week. I'll speak to you soon.